What if the biggest silver crash in recent memory was not a crash at all? What if it was the most calculated, perfectly timed wealth transfer you have ever witnessed? I'm going to show you exactly why silver just collapsed from $96 all the way down to $83 in a matter of days. And I'm going to show you who did it. And most importantly, I'm going to show you why this was never a disaster. It was an invitation. Right now, explosions are rocking the Gulf. Iran strikes are sending shockwaves across global markets. Pakistan is erupting with protests against the United States. Hotel debris is injuring civilians, and silver, the metal that was screaming toward $100, just got slammed to the floor. Coincidence? Absolutely not. Listen closely, because by the end of this video, you will know the real plan behind this collapse. You will understand why March 2026 could be the most important month in silver's modern history, and you will know exactly how I am positioning my own money right now. Stay with me. This is the one video you cannot afford to miss. Let's talk about what is happening on the ground right now. March 6, 2026. Reports are coming in of fresh explosions linked to Iranian military strikes in the Gulf region. A hotel near a key strategic zone has sustained structural damage from debris. Civilians are being injured. Pakistan streets are filling with protesters, directly targeting US interests and policy in the region. This is not background noise. This is the kind of geopolitical fire that historically sends precious metals into orbit. So why did silver just drop? Why, when the world is burning, did the metal known as the ultimate crisis asset just fall off a cliff? Here is where it gets interesting. Silver hit $96 just days ago. Traders were screaming $100 was coming. Social media was flooded with excitement. Then, without warning, silver was smashed down to $83, a $13 drop in days. That is roughly a 13% collapse in one of the most bullish geopolitical environments in years. Something does not add up unless you understand the game being played. Let me give you the numbers that will make your jaw drop. Right now, the paper to physical silver ratio on the COMEX stands at approximately 365 to 1. That means for every single ounce of real physical silver sitting in COMEX vaults, there are 365 paper contracts claiming ownership of that same ounce, 365 to 1. Think about that. COMEX registered silver inventories have been tightening for months. Major financial institutions have been caught holding enormous short positions on silver. And yet, despite record industrial demand, record supply deficits, and a global geopolitical crisis, silver just crashed. This was not the market speaking. This was the market being spoken to. Big players, institutions with access to billions in paper contracts, deliberately triggered this sell-off. The goal? Shake out the retail traders, collapse the price artificially, and then quietly, methodically, stack physical ounces at discount prices before the real move begins. This wasn't random. This was a plan, and I'm going to show you exactly what comes next. Let's zoom out. Because silver does not move in isolation. Silver moves with the monetary system. And right now, the monetary system is under historic stress. The United States has printed more money in the last 5 years than in its entire previous history combined. Let that sink in. The Federal Reserve's balance sheet exploded. Government debt is now above $36 trillion. Interest payments alone are consuming over $1 trillion per year. This is not sustainable. Every single time in history that a government has debased its currency at this scale, hard assets have exploded in value. Gold knew this first. Silver is catching up. But here is what makes silver truly special right now. The BRICS nations, Brazil, Russia, India, China, South Africa, and their growing coalition are actively building alternatives to dollar-denominated trade. New payment corridors, new reserve mechanisms, some openly backed by gold. When the dollar loses its monopoly on global trade, silver doesn't just benefit, silver accelerates. Because silver is not just money, silver is industry. And industry does not care what currency it uses. It just needs the metal. Here is the number that changes everything. The global silver supply deficit is now over 200 million ounces per year. 200 million ounces every single year. The world is consuming more silver than it produces. And this deficit is not slowing down, it is accelerating. Why? Solar panels. Every solar panel manufactured requires silver. The global push toward renewable energy, driven by government mandates, corporate sustainability pledges, and energy security concerns, is consuming silver at a breathtaking pace. Solar demand alone is projected to require hundreds of millions of additional ounces over the next decade. Then add electric vehicles. Every EV uses silver in its electrical systems, contacts, and battery management technology. EV production is growing exponentially. Then add 5 grams infrastructure, medical devices, semiconductors, defense technology. Silver is not just a precious metal sitting in a vault. Silver is the irreplaceable backbone of the modern technological economy. And here is the terrifying part for anyone not holding silver right now. There is no substitute. Engineers have tried. Copper works for some applications. But for conductivity, reflectivity, and antibacterial properties at industrial scale, nothing replaces silver. The world is consuming silver faster than it can mine it, and mines are not keeping up. New mine development takes 10 to 15 years from discovery to production. The supply crisis is structural. It is not going away. And $83 silver is a gift. Now layer in what is happening geopolitically right now. Iran strikes in the Gulf, potential disruption to shipping lanes, tensions with Pakistan escalating, broader Middle East instability threatening energy infrastructure. Silver mines are heavily concentrated in politically sensitive regions. Mexico is the world's largest silver producer. Peru, Chile, Bolivia, and parts of Central Asia are also major sources. Any disruption to global trade routes, any escalation in resource nationalism, any supply chain breakdown hits silver supply first and hardest. And here is something most retail investors never consider. In a serious geopolitical escalation, silver does not just benefit from fear-driven buying. Silver becomes strategically critical. Military technology, communications infrastructure, medical supply chains all require silver. Governments know this, which is why strategic reserve discussions around silver are beginning to quietly emerge in policy circles. The geopolitical risk premium on silver is not priced in yet, but it will be. Let me show you the math that smart money is using right now. The gold-silver ratio. This ratio tells you how many ounces of silver it takes to buy 1 ounce of gold. Historically, for thousands of years, this ratio averaged around 15 to 1. In nature, silver is mined at roughly a 9 to 1 ratio versus gold. Right now, the ratio is sitting near 90 to 1. Gold is at approximately $2,900. Divide that by 90. That gives you a silver price of around $32. But silver is at $83. The ratio has already started compressing. Now watch what happens when the ratio moves toward its 5-year average of around 70 to 1. At a gold price of $2,900, a 70 to 1 ratio gives you silver at over $41. But analysts are not targeting $41. They are targeting gold at $3,200, $3,500. And beyond, at $3,200 gold and a 70 to 1 ratio, silver targets $45. At a 50 to 1 ratio, which is still above the historical average, silver targets $64. And if the ratio compresses to 25 to 1, which it has done before during silver bull markets, you are looking at silver above $120 to $128. This is not fantasy. This is arithmetic. And the arithmetic is pointing directly at explosive upside from current levels. Let me explain the most dangerous game in finance. Right now, paper silver. When you buy a silver ETF, a futures contract, or a leveraged silver position, you do not own silver. You own a promise. A promise backed by a 365 to 1 paper to physical ratio. That means the system only works as long as nobody asks for delivery. But people are starting to ask for delivery. Large institutions, foreign governments, sophisticated investors who understand what is happening. When the paper market is forced to reconcile with physical reality, the price adjustment will not be gentle. It will be violent. It will be sudden. And it will reward everyone holding physical metal while punishing everyone holding paper promises. The smart money is not buying silver ETFs right now. The smart money is buying physical ounces, coins, bars, and allocated accounts, while the paper price is artificially suppressed at $83. This is the window, and windows like this do not stay open forever. Now let me put it all together. Here is the plan as I see it. Silver spikes to $96, driven by genuine industrial demand, geopolitical fear, and monetary instability. Big players with massive short positions on paper silver are suddenly underwater. They need to cover their shorts, but they also need to build physical positions before the real breakout. So they use their enormous paper market leverage to hammer the price down. Retail traders panic and sell. Weak hands exit. Price crashes to $83. And while you are watching the chart fall, the same institutions are quietly buying every physical ounce available at the discounted price. This is not a conspiracy theory. This is a documented pattern that has repeated multiple times in silver's recent history, and once they have built their physical position, they step back. The industrial demand does not stop. The supply deficit does not shrink. The geopolitical pressure does not ease. And silver begins its next leg up, not to $96, not just to $100, but potentially to $120 and beyond the timeline. The forces converging right now suggest March to June 2026 is the critical window. BRICS monetary developments scheduled for mid-2026, industrial demand continuing to outpace supply, the paper market under increasing stress from delivery demands, and a geopolitical environment that is getting more volatile, not less. $120 is not a prediction. It is a destination that the fundamentals are pointing toward. So what do you actually do? Let me be direct. First, if you do not own any physical silver, now is the time to start, not paper silver, physical. Coins, bars, rounds from reputable established dealers. Do your research, compare premiums. Start with recognizable government-minted coins like American Silver Eagles, Canadian Maple Leafs, or Austrian Philharmonics. These carry the highest liquidity when you eventually sell. Second, dollar cost average. Do not try to pick the absolute bottom. Nobody can do that consistently by a set amount every week or every month. This smooths out volatility and removes the emotional stress of timing the market. Third, separate your physical holding from any paper exposure. If you want leveraged upside through miners or ETFs, treat that as a separate, smaller, higher-risk portion of your overall position. Your physical silver is your foundation. It is insurance, hard money, and a store of value all in one. Fourth, stay informed. The silver market moves on news fast. Geopolitical events, COMEX data, industrial demand reports, Fed policy shifts, these all matter. Which is why I am building a community right here on this channel. People who are paying attention. People who are positioning ahead of the crowd. If you are not subscribed yet, fix that right now. Hit the subscribe button. Turn on notifications, because the next video is going to cover something even bigger, and you cannot afford to be late. Silver's crash from $96 to $83 was not organic market weakness. It was a calculated, engineered pullback designed to shake out retail and allow large players to accumulate physical at suppressed prices. The fundamentals have not changed. The 200 million ounce annual supply deficit is real and growing. Industrial demand from solar, EVs, semiconductors, and defense is accelerating with no substitute for silver in sight. The gold-silver ratio math points clearly toward $120 plus silver as a realistic target in 2026. The paper-to-physical ratio of 365 to 1 is a ticking clock that, when it unwinds, will send physical silver prices to levels most people are not prepared for. And the geopolitical chaos unfolding right now in the Gulf with Iran strikes, regional instability, and shifting global alliances is adding a risk premium that has not yet been fully priced into the silver market. The people who understand this are buying now. The people who don't will be watching from the sidelines wishing they had. I have made my decision. I am buying physical silver at these levels. Not because someone told me to, because the data, the history, and the math all point in the same direction. Now you have the same information. What you do with it is your choice. But I will tell you this, opportunities like this, where fundamentals are screaming, and the price is temporarily suppressed, are rare, and they do not last. The next video is going to go even deeper. I am going to break down which silver products carry the lowest premiums right now, how to store physical silver safely, and what the next major catalyst event on the calendar looks like. You do not want to miss it. If this video gave you value, do one thing for me right now. Hit the like button. It takes 1 second, but it helps. This information reach the people who need it most. Subscribe if you are not already here. Hit the bell so you never miss an update. And drop a comment below telling me where you think silver is headed by the end of 2026. I read every single one. This is your community. Stay sharp, stay informed, and I will see you in the next one.